Welcome to today's video. It's the Fed stupid, the Fed disappoints Wall Street. The Fed ended its two-day meeting letting investors know that interest rates were going to be higher for longer. We find ourselves amidst a financial conundrum in 2024, where Wall Street's hopes are dashed by the Federal Reserve's unyielding monetary policy. The phrase, "It's the Fed stupid," echoes through the corridors of finance, encapsulating the pervasive disappointment. This presentation, brought to you by Higgins Capital, aims to unravel the reasons behind this discontent. So, sit back and let's delve deeper into why Wall Street is disappointed. The Federal Reserve has maintained a steady stance on interest rates, driven by sticky inflation and a strong labor market. This rigidity, in 2024, has been the source of Wall Street's frustration, echoing the sentiment, "It's the Fed stupid." Despite Wall Street's hope for a more accommodating Federal Reserve, disappointment arises as the Fed's stance holds firm, leaving interest rates unaltered. This decision is not without reason. The Fed has a keen eye on the robust labor market and persistent inflation, which have been key factors influencing this policy. However, this stance is perceived by investors as overly cautious, neglecting potential economic risks. The Fed's reluctance to ease policy exacerbates concerns about a global economic slowdown and limits the tools available for future crises. The Fed's actions are not isolated, they ripple across the global financial system, impacting currency values and emerging markets. The world watches Wall Street, and Wall Street scrutinizes every move of the Federal Reserve. The hope for a shift towards accommodation lingers, but for now, disappointment is the prevailing sentiment. Yet in this climate of monetary tightening, investors must adapt to the Fed's stance. This adaptation requires a focus on fundamentals and maintaining a long-term perspective. The phrase, "It's the Fed stupid," underscores the critical role of monetary policy in shaping financial markets. It's a reminder that the Fed's decisions can stir disappointment, prompt scrutiny, and influence global financial systems. Yet it also signals an opportunity for investors to navigate these challenges, to position for success in a climate influenced by the Federal Reserve's policies. Despite the disappointment, Wall Street must adapt to the Fed's stance. The adaptation may not be easy, but it's necessary in this era of monetary policy where the Federal Reserve holds the reins of the global financial system. Wall Street's hopes for a more accommodating Fed are not being met. So, what do investors do? Now, more than ever, it's crucial to adapt to the Fed's stance. This calls for a shift in strategy, a renewed emphasis on fundamentals, and a commitment to maintaining a long-term perspective amidst monetary tightening. In this climate, it's easy to get swept up in the headlines, the speculation, and the disappointment. But the seasoned investor knows better. They understand that the market is a complex ecosystem, influenced by a myriad of factors, not just the Fed's monetary policy. They focus on the fundamentals. They scrutinize balance sheets, cash flow statements, and income statements. They analyze market trends and economic indicators. They understand that these fundamentals, these hard numbers, are the bedrock of sound investment decision-making, and they commit to a long-term perspective. Short-term market fluctuations may be disconcerting, but the long-term investor remains unfazed. They know that over time, the market has an upward trajectory. They understand that patience, not panic, is the key to investment success. Yes, the Fed's stance may be disappointing for some, it may pose challenges and uncertainties, but it also presents opportunities for those willing to navigate these turbulent waters with a steady hand and a focused mind. Ultimately, it's about understanding the critical role of monetary policy in shaping financial markets. The phrase, "It's the Fed stupid," underscores the significance of the Fed's decisions on the global economy and financial markets. As we've seen, the Fed's unyielding stance in 2024 has not only disappointed Wall Street, but also sent ripples across the global financial system. Despite the frustration, it's crucial to realize that the Fed's decisions are influenced by a myriad of factors, such as sticky inflation and a robust labor market. While the Fed's caution may seem excessive to some, it's part of a larger, more complex economic picture. Investors, therefore, must adapt to this stance by focusing on fundamentals and maintaining a long-term perspective amidst monetary tightening. The challenges posed by the Fed's decisions are not insurmountable, but they do require a keen understanding of the financial markets and a strategic approach. As we conclude, remember, in the face of a firm Fed, Wall Street needs to focus on the bigger picture and adapt. Thank you for joining us today.